Your job is over budget. Your job is over budget. Now what? You built the budget. The job started. And now actual costs are telling you something you don't want to hear. This job is going over. The worst thing you can do right now is start moving numbers around just to make that variance disappear. Before you touch anything, we're going to figure out what happened, why it happened, and what this job is really expected to cost. So how does a budget actually get busted? A few common ways. A bad takeoff or estimating miss, wrong quantities, missed material, not enough labor hours, or a missed piece of subcontract scope. A productivity overrun, where the work simply takes more labor hours than estimated. A material or subcontract overrun, price increases, waste, rework, or gaps in scope. Unexpected field conditions, and customer scope changes. Here's the important teaching point. Not every overrun is a change order. A bad takeoff or poor productivity is generally an internal cost problem. It does not, by itself, change the customer's contract price. Don't just tell me the job is $40,000 over. Tell me where. Pull budget versus actual by cost code, labor, material, subcontract, equipment, general conditions, other. Then investigate the cause in whichever code is bleeding. A variance isn't the answer. It's the clue. Once you know where the variance is, classify it into one of three buckets. First, a forecast or EAC change, things like a bad takeoff, an estimating miss, productivity loss, a material price increase, or a field condition affecting expected cost. Here you update the current EAC based on the best information you have. You do not rewrite the original baseline just because the job is performing worse than planned. Second, an approved internal budget revision or transfer. If company policy allows it, get proper approval, document the reason, preserve the original budget, and maintain the revision history. Never move budget simply to hide an unfavorable variance. Third, a customer scope or contract change. An approved change may affect contract value, expected costs, the job budget, and the current EAC. Exactly how that gets recorded should follow your company's accounting policy and your CPA's guidance. Let's make this concrete. Say the original material takeoff was 1,000 units at $10, $10,000. After the job begins, the team discovers the actual requirement should have been 1,500 units, $15,000. That's a $5,000 unfavorable estimating miss. Here's the key. Discovering that mistake does not create $5,000 of customer revenue. Instead, the original baseline stays at $10,000, the current expected material cost moves to $15,000, and the forecast, the EAC, increases by $5,000. We preserve what was originally estimated while making the current forecast reflect reality. So when should the job budget itself actually change? Not just because you don't like the variance. Company policy should determine when a formal internal budget revision is permitted. Legitimate examples might include an approved customer change order with related cost, a formal management-approved budget transfer, or a formal approved budget revision under company policy. An ordinary cost overrun, estimating miss, or productivity problem should not automatically cause the original baseline to be rewritten. Never revise a budget simply to make an unfavorable variance disappear. Whatever you decide, preserve the audit trail. Look at this budget history. Original budget, $400,000. Approved change order number 1 adds $20,000. Approved transfer number 1 moves $10,000 from material to labor with no net change. Current approved budget, $420,000. Do not overwrite the original number. A reviewer should be able to see where the budget began, what changed, when it changed, why it changed, and who approved it. A simple revision log, date, revision or CO number, cost code, previous amount, change, revised amount, reason, approved by, and supporting documentation, does the job. Exactly how you post that in your software will vary. There's no single universal method across every construction accounting system. Let's continue the example. Original budget, $400,000. Approved changes bring it to a current approved budget of $420,000. Now say poor labor productivity is expected to cost another $25,000. That gives us a current EAC of $445,000, a forecast variance of $25,000, unfavorable. Do not add that $25,000 to the approved budget just to make the variance disappear. The budget history tells us what was approved. The EAC tells us what we currently expect the job to cost. And the variance tells management exactly where the problem is. Now follow that through to profit. This is a $500,000 contract. Before the additional overrun, expected cost was $420,000 for a projected gross profit of $80,000. After we recognize the $25,000 overrun, the current EAC is $445,000 and projected gross profit drops to $55,000, a $25,000 deterioration. And here's the thing to remember. Accounting didn't lose that $25,000 by updating the forecast. The job had already lost it. Accounting is simply making the financial information reflect what we now know. Now let's follow it through to percent complete for companies using the cost-to-cost method. Cost incurred to date is $200,000. Before the EAC update, $200,000 divided by $420,000 is 47.62% complete. After the update, $200,000 divided by $445,000 is 44.94% complete. Nothing changed in actual cost incurred to date. What changed was our best current estimate of total expected cost, and that alone moved percent complete. That percentage flows straight into earned revenue. On this $500,000 contract before the update, 47.619% of $500,000 is roughly $238,095 of cumulative earned revenue. After the update, 44.944% works out to roughly $224,719, about $13,376 less. A stale EAC doesn't stay isolated on a job cost report. It can distort percent complete earned revenue, projected profit, and WIP. Earned revenue by itself is not an overbilling or underbilling. It has to be compared to billings. The sequence runs current EAC to percent complete to cumulative earned revenue, and then you compare that to billings to date to find your over or underbilling position. In our example, cumulative earned revenue is $224,719. Billings to date are $235,000. Billings are ahead of earned revenue by about $10,281. For this simplified example, that's an overbilling, a contract liability position. So where does the bookkeeper fit into all of this? Not by inventing a new EAC on your own. Your job is to recognize the warning signs and ask questions. Say labor is already at 90% of budget, but the PM says the job is only 60% complete. Ask, what work remains? How many labor hours remain? What material remains? What commitments haven't hit accounting yet? Are there pending changes? Is this an estimating miss, a field overrun, or a customer scope change? And what does the PM now expect the job to actually cost? Accounting plus operations equals a reliable forecast. Let's pull the whole busted budget process together. Identify where the variance is. Investigate why it happened. Classify it. Is this a forecast change, an approved budget revision, or a customer scope change? Approve it. Get the required authorization. Document it. Preserve the audit trail. Forecast. Update the current EAC honestly. And follow it through. Understand the impact on profit, percent complete, earned revenue, and WIP. Here's what I want you to walk away with. A busted budget isn't the failure. Finding out at the end of the job is. The original budget tells you where you started. The current approved budget shows the legitimate approved changes. The current EAC tells you where you now expect to finish. And the variance tells you what needs attention. The purpose of the original budget is to preserve the plan. The purpose of the current forecast is to tell the truth. Thanks for spending this time with me. If you have a construction accounting question,